If you're looking to buy ENDO International stock, then please keep watching this video because we're going to look at the company's recent news, how's the market treating it, what are the technicals telling us, and most importantly, what is the best trading approach. As the market remains very volatile at the moment, we should be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Endo Pharma is an Irish pharmaceutical company who lost a significant portion of its stock value over the past few months. A lot of traders are wondering if it can recover from there and to make a quick and handsome gain from the stock over the next few weeks or month. So far, Endo has been having a bit of a downward pressure, not just because, frankly, the market in general has been very challenging, but also because the company itself has been having a huge amount of liabilities, and this really worried the investors. Usually, a company has a lot of debt because it needs to raise money by borrowing from financial institutions, and that these spendings haven't provided the returns just yet. One alternative way to raise money is to sell its shares, and doing so would dilute the current shareholders. So this is why sometimes companies would prefer to borrow the funds. Another aspect to consider is that if a company has a lot of debt, then there are possibilities for the company to declare insolvency if they cannot pay back the principal that is due, or if they cannot pay back the interest payment. As for the rewards, Endo Pharma is currently having a few new products to be submitted to the regulators to see if they could be commercialized. With that being said, those scenarios tend to be a bit too random or risky to be a predictable outcome. So this is why the main attraction of Endo at the moment are the low price action and the fact that it may have new products coming around. With that being said, it's a very risky position to be had, and it would fit with portfolios that are risk tolerant and sufficiently diversified to take that kind of risks. Now, let's take a look at the technicals of the stock. The trading volume of Endo has recently been around 23 million shares versus an average volume of 40 million shares. Over the past 52-week period, its price fluctuated between 28 cents and $7.06. The volume of shares traded tells us how many shares are being bought and sold at any time in the market and if there's enough liquidity to support such a trading strategy. If the float is very thin, it would be easy to influence the stock price, but low liquidity could mean that the demand is limited as well. When we compare the current volume against the average volume, there might be a possibility for a trend reversal or breakthrough if the difference is very large. For example, if the stock were to break through, the current volume could be very high compared to the average volume. The market cap of Endo is currently around $165 million versus an enterprise value of above $7 billion. Simply put, the market cap is the fair market value the company has based on the current market sentiment, the company's reputation, and other macroeconomic factors. The enterprise value is usually the cost the company paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies may be the intangibles, meaning they're not items but more pledges for a better future. So they could be intellectual properties, brandings, and so on. Many small cap companies and startups, most of their valuations are based on those intangibles, meaning they could be valued in more favorable market conditions, and this could end up having a huge difference between the market cap and the enterprise value, giving a false impression to market participants that the company is trading at a discount. It's only trading below its book value in reality, but it doesn't mean that a company itself is necessarily undervalued. It could also be overvalued to begin with, and only deflating back to where it's supposed to be ever since. As we compare the current price to the historical price fluctuations, the stock is 91% higher than the 1-month low, 153% higher than the 90 days low, and 153% higher than the 52-week low. On the options market, giving a hint on the market sentiment of where the stock price is likely going to go next, the implied volatility is currently around 318% versus a historical volatility of 263%. The put-call volume ratio is currently around 0.01 or 1%. It is normal for most stocks to also tend to have a higher put option volume than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 905 contracts within a day versus the 30-day average of around 4,000 contracts. Regarding the open interest, the most recent volume of open interest is about 80,000 contracts versus the 30-day average of 66,000 contracts. The options contracts are tools allowing traders to hedge their risks, increase their exposure with limited downside, or a revenue stream. They are derivative contracts based on the underlying security's value. They give traders the possibility to buy or sell the security at a predetermined strike price and helps limiting the potential downside. The put options allow selling at the strike price, usually chosen for the anticipated downturn, and the call options allow buying at the strike price, usually for an anticipated bullish run. In terms of shareholder structure, institutional shareholders own 82% of its outstanding shares. The biggest shareholders include Vanguard, Paulson & Co., and Renaissance. Usually, it is best to see some institutional participation when holding a stock long-term because it offers a layer of stability and token of reliability in the medium to long term. It means that the market is confident that it will deliver value in the long term, which is an important factor to consider. I personally consider the usual minimum threshold to be between 25 to 30% of institutional ownership, although there are many exceptions to this rule, as there will always be great companies mostly owned by retail traders, just like there will be problematic companies mostly owned by institutional ones. And I think that ENDO, in this case, is the case for the latter. Let's also take a look at the short interest in the stock, which is the number of positions that will profit from falling stock price. The way it works is that the short positions will borrow the shares from the broker, sell them in the market, and buy them back later, profiting from the difference between the two timings. If there are significant short interest, usually above 25 to 30%, there would be a potential for a short squeeze, whereby traders will buy the stock up, forcing those with the short positions to redeem their positions to avoid further losses, acting as a buy for the stock's price action. This is what people refer to as a short squeeze, and it became a popular concept in recent times, with stocks like GameStop and AMC being successfully short squeezed. The current short interest is around 20% of the total float, and 49% of those transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, with a significant portion of the short volume coming out of the dark pools, this could suggest that there are institutional positions taken to short the stock and that there would be potentials for a short squeeze. My recommendation for ENDO International is to take a position in the stock as a marginal position for the short term if you're willing to take the risk. If the main goal is to invest in a company for the long term, then it would be better to look elsewhere. I would recommend to commit between maximum 0.5% to 1% of your portfolio in ENDO, and would also recommend to split the allocation in about 20 to 30% at a time to benefit from further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance. since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.